I start recording it now. So I take this opportunity to welcome all the exchange students who joined this track. I must say that you're very brave people that you have joined the track, because this is not just studying about contents. It's about the application in the research field. So great. Because last week I only called upon the track students because we were discussing more from the point of view of the research projects, some thesis point of view. So I strongly recommend the track students that they should always use this Zoom link. It's a common link for everybody and for all the meetings. And very often you might see that you have been contacted by Stefan Petrov. Stefan is here. Would you like to say hi to everybody?
Hello, everyone. I'm not connected to the audio, so I'm talking to your computer.
Okay, Stefan is here. And then Seher is also.
Hello, everyone. I'm here.
Seher is here. And Tatiana Kaupinen, she is not with us today. So you might see some messages coming from these three human beings as well. So, and then the schedule is mentioned here. We will be always meeting in B115, the room where we are in now. But if you are following through Zoom, then that doesn't matter. The news section is here and the discussion forum. Just very quickly, the news is when we want to intimate you and it doesn't require any reaction from your side. So it's just an intimation. So you need to know it. But if you want to have some kind of chit chat, some kind of communication with us, then the discussion forum is the right platform. And I strongly recommend you that read the intended learning outcomes of this track. And more importantly, the course assessment criteria. Remember that I would be assessing the IB students, section A, and the exchange students, section B, differently. Because the whole purpose of you two groups joining this track is completely different. So I would be assessing you differently. So for the exchange students, please go through this B section thoroughly, that how you will be assessed. Okay. You have to do only one assignment, and you are supposed to make a presentation based on that assignment as well. And that is something you need to learn thoroughly. And this presentation would be held on 16th of December. So you got plenty of time. So for this whole you can call it course or track, whatever. I think the track word is more appropriate for the students who will be writing thesis in finance and corporate governance. The exchange student can call it like a normal course. Okay. So the entire course assessment is based on this one assignment, one big assignment. Okay. But if it is a one assignment, that doesn't mean that you wake up in the month of November and start preparing it. Okay, so already you should start working on it. It will be time consuming and it's an individual presentation, no group task. And this one assignment carries entire 100% of your total credit. So go through it. So these two things, I recommend you that the exchange student should go through. They should be aware of the basics of this course, what is required, what is expected from you, and the course assessment criteria. Very quickly, to everybody, track students and exchange students, I quickly want to introduce you to the course contents and the study material. Your main primary sources of information about the contents are the lecture slides. As you can see that I have already uploaded one topic, valuation of equity assets. So today we shall be studying that how you evaluate your company, basically. And one reason I'm taking up this topic is because many of the track students are doing a project with Utrecht University. And this project is based on valuation, by the way. So today's lesson would be kind of buy one, get one free thing, that you will be learning something which is useful for your track, for your knowledge, but at the same time, you can also apply it in the real life. Like, for example, we are doing this project. So that's the reason I chose this topic. So if you have any questions, comments, the online students, please feel free to either stop me and speak out loud, or you can send your opinions through chat. And Seher and Stefan are here to read out those chats, and if there is something important, they can bring to my notice. And if something they can do on their end, they would happily do it. So without any further ado, I want to take you to the topic 1, which is valuation. And as I said before, if you have any question, query, never stop yourself. Just say it loud. The topic which I want to begin today is the equity asset valuation. A firm has the equity, the share capital, and the point is that how do we evaluate it? Remember, there is always a market price. If you take any stock, if you go to any, if you want to know how much is Microsoft selling today, now rather, you can just go to some web pages and check the price. But then the question arises, if looking at the value of the company, and how do you find the value? You multiply the one price of the share, multiply with the total amount of shares in the market of that company. And what you get the total value of equity capital. We also call it market capitalization. Market capitalization. And as a acronym, as a kind of short form, we also call it market cap. Okay. So for example, if I quickly stop sharing this screen and instead I open a window and I take you to Yahoo Finance. Why is computer so slow? Yahoo Finance, okay. Let me know if the window is visible. If not, then I can do it now. Because I use these two words. Yeah, it's here. So for example, this is page Yahoo Finance. And if you want to look at the value, the market value of some company, okay? So for instance, if I type in British Petroleum, or let's say, if I want to type BP, do I get something? Sure, I would. Yeah, BP PLC, London Stock Exchange. So if I click that, look, this is 87.189 billion. Are they dollars or it's in pounds? Because I click London Stock Exchange. Let me check. New York Stock Exchange, doesn't matter. I mean, because some stock can be trading in multiple exchanges. No, not a big deal. So in New York Stock Exchange, the market value of entire company called British Petroleum is 87 point, I would say about $87 billion. Yeah, it can be more than the GDP of some countries, $87 billion. And how do we get 87 billion? Well, the way we get it, we multiply the price of the market, the stock. For example, yesterday, the price was closed at $24.65. And if you multiply, for example, if you multiply by the number of shares of BP, the answer is 87.189 billion. So if you multiply price per share with the number of shares outstanding mean which are circulating in the market, the product is called market cap or market capitalization. In this case, it's 87.189. And you can see that the market price keeps changing every moment. I hope you know it. For example, yesterday, when the market was functioning, if I want to show you a bit of more about BP, yeah, here we go. So yesterday, when the market was functioning, and if I take 1 day price, yeah, so you can see that, I hope you can see that 10 a.m., noon, and in the afternoon, the price have been varying, even though the range of the variation was very less. So you can see that I would say that at 9 a.m., the total market cap would have been higher in comparison to about noon, when the market price was going down. You can see that there is a height and there is a valley. So when the price goes down, the market cap goes down, and when the price goes up, the market value goes up. So you can see that if you want to look the market value of a company, it varies after every few minutes or after a few seconds. If I want to give you some real life example, for instance, it's 10 o'clock now here in Finland. So if I look for Nokia, for example, or let's say Finnair, and I click Helsinki, because the market usually starts at about 9. And you can see here that there is in the bracket something green light flashes. It means that from some moments ago, the price has increased. Now you can see it changes. So whenever there's a change, there's a flash. And usually this flash comes after every few seconds. If the flash is the green, it means the price has increased than before. And if the flash is red, it means that the price has gone down than before. This before thing, we don't know. It can be every time when the price moves, there is a movement. Okay, so you can see that the price can be, and by the way, this is not because it's not a paid source. It's a free website. So it's the price you see are trailing by 15 minutes. So don't make any decision based on it. Okay, so because there's a trailing, but if you subscribe to it or some other website, then you can see more authentic information. But this is authentic as well, but this is trailing. This is with the lag of time. So the point I'm trying to make here is that the market cap is changing every moment. But the question is, if the market value is so easy to see, then why are we wasting time and studying this topic called valuation? There's a reason for it. The reason is that where is the that's better. The reason is this, that we want to see a very important objective of studying this topic called valuation is that we want to study that is market treating you in a very fair manner? Is the market price that you see in the web pages, is it a fair price? What should be the fair price? What should be the theoretical price? What should be the notional price? what should be the intrinsic price. And when you compare with this, the real market price, then you are able to compare that is the stock being overvalued or undervalued. Basically, if the price is overvalued or undervalued, it means that there's a deviation between the company's real fundamental price and the market price. Larger is the deviation, more is the room for speculation and getting the arbitrage profit. Arbitrage means when you are able to make a big go. Imagine you are so technically sophisticated and you have got a lot of knowledge about econometrics, about the accounting fundamentals, the financial measurement, and you are able to determine that, you know what, the BP price, the theoretical price, in theory, by making very in-depth analysis, you find out that BP price should be $22. Whereas some time ago you saw it was 26 point something, yeah? It means what? BP is overvalued. It means the justified or the fair price of the BP is 22, but the market price is 26. It means market is treating BP favorably, over favorably. It means BP is overvalued. And then you make a decision based on it. Some investors can think that, hey, you know what, this $4 per share deviation is only momentarily. Eventually, in the long run, we always assume that the fundamental price and the market price, they always converge. They always go together. So you know what? It's a time to sell BP and make money. Because eventually, this 26 will go down and it will go to the average price. So before it happens, give a big go. So it means you make the decisions based on it. If you don't have the theoretical price, you will never be able to judge that if the current market price is overvalued or undervalued. You need some benchmark. So that this topic, which we study today, it will provide you the benchmarks against which you can compare the market price, and then you make a decision based on it. When you work as the financial consultants, or when you work as the in some university, you become some PhD researchers, then you'll be asked by your superiors that, hey, make a list of overvalued and undervalued stocks today. Then you can't just go to Yahoo Finance and make a list of the stocks. No, how do you know it's overvalued or undervalued? Then you apply these techniques. And then you say that, you know what, we have 100 stocks today, 50 are overvalued, 30 are fair priced, and 20 are undervalued. That's what you do. Ivan, you have a question?
No.
Yeah. So this is some background of this topic. But feel free to stop, ask me anything whenever something comes to your mind. Yep.
My question is, why stock is rising? I mean, not a certain topic, but I think something related. Because in my understanding, the more buyers than the sellers, then stock price is going up. The more sellers than the buyers, it's going down. But it's a little bit complicated on the practice.
No, you actually answered yourself. Actually, you asked the question and you very well answered that. It's at the end of the day, it's a price mechanism. You ask very important question. I think I should answer you before I go further. To everybody, sorry, what's your name? Maxim asked a very important question. He said that why do the price increase or let's say decrease? And then he slightly hinted that is it because of the demand and supply forces? Is it the buying and selling thing? And he's absolutely right. As a matter of fact, the reason why the prices go up or down belongs to the very simple diagram that we study in economics, which is the demand curve and supply curve. Do you know that? The cross, the junction. Yeah. Let me show you something. Now, because you asked me, so I'm tempted to discuss this point with you before I go next.
Tesla is, in my opinion, so overvalued.
Yeah.
It's still high. It's not like going down, even though the fundamentals are not so good as the market price.
Yeah. Okay. Let's say this is Tesla, and here we take the stock price. Let me call it SP, stock price of Tesla, and here I take the day. So I'm just taking the day comparison, okay? And let's say the market starts at 9, and then we check the price at noon, and then we check the price at about 4 o'clock when the market is about to shut down, okay? And in between, you can imagine different. And just imagine, hypothetically, that Tesla started at 500 at 9 a.m. But then within a few minutes, the price went down. But around 11 a.m., there was some positive news. Maybe Elon Musk pasted some nice picture in Instagram or whatever. So the nice optics, people like it, they love it. There are so many likes, and that also reflected in the stock market. And that happens. Some minor optics can make a big change. The price can also fall. Seeing his picture when his shoulders are slouching and his head is down, and it can be read as that, hey, you know what, Tesla has a very bad day today. Look at the way Mr. Musk is reacting. Look at his face is so gloomy, and the stock price can go down. So all these minor things, optics. There is a saying that in politics and in finance, more than the substance, the optics matter more. What type of signal you give. Okay. So anyway, to cut the long story short, let's say that this has been the trend all day. Yeah, from 9 a.m. to 4 p.m. The point is that each point, if you take, for example, if I take 1 point, so I'm making the circle where I want to make some kind of an analysis. Okay, each point is basically showing this across. And you know who are these crosses? These are demand and supply curves. So basically, there are infinite demand and supply curves you witness on daily basis, because this line is not like a dot, it's like a continuous line, and you can draw maybe millions and billions of. You can calculate the stock price not only on minute to minute basis, you can also make it from second to second basis. Okay, so there is a continuous pattern for the demand and supply. So for example, this is the beauty of finance. If you learn in economics, there is a demand curve and supply curve, you have to think about finding the example. Where is demand and where is supply? Here we have the application, the real life application. That look, there is a demand curve and supply curve. So they are in action. So that is why economics is so important in finance. It's always very, very, you are very rich in knowledge and your logical thinking if before entering the world of finance, you have some fundamental knowledge of economics and accounting. If you know that, then it shouldn't be a problem. So the point I'm trying to make here, I'm just extending the point you mentioned, that why do price go up and down? Well, it's because of demand and supply. And demand and supply is the foundation of our basic economics, demand curve and supply curve, this cross.
And also, saw some companies which had like good fundamentals,
Mhm.
new innovations, like competitiveness on the market, but they are not rising as some Chinese stock.
Mhm.
As for example, American stocks, which gain about like 30% per year.
Yeah.
And I like just wanted to find out like how why it happened, because the fundamentals is really good, but people are not buying it, or
Mhm.
why stock?
Yeah, I get your point. Maxim raised a very important point. He said that sometimes it happened that the fundamentals of some companies are very good. They make a lot of innovation. They spend a lot of money on R&D, and the market prospects are very good as well. But the price doesn't really reflect so much. It doesn't really increase. I would answer that for some stocks and in some markets, there is a reaction time. The reaction time can be instant to some years. So it depends. Sometimes in certain sectors, in certain industry, and even for certain companies, and even in certain stock exchanges, the market reaction is instant. Whereas in the others, the reaction can take a while. And it also depends on, Maxim, it also depends upon how some investor, because you see what, when we say the word investors, there's a danger of making a mistake that we think that all the investors are homogeneous. They think alike. That's a big assumption. It's not true. For the same action of a company, some investor would react positively, some would react negatively. Let me give you an example. A company has some spare 1 million euros to spend, extra surplus cash. And let's say that people who are sitting on this side, they are the short-term investors. Your time window is not more than 3 months. Whereas people sitting on the left side, they have very long-term horizon. And this company decides that they would spend this surplus cash of 1 million. They will not give they will not give dividends, but rather they would reinvest in the company. Guess what? These people who are sitting on the right side, who were expecting dividends, they would be very angry, believe me. But then people who are sitting on the left side, who want to stick with the company for a relatively long period, you guys will be very happy, euphoric, great, because you are going to stick with the company for a couple of years. And let's imagine that this innovation becomes successful. Look what happens. Stock price would skyrocket. These people sitting on the right side, they are only with the company maybe for a month or 3 months. So they don't care if a company, does innovation or not. So guess what happens? Some investors react positively, some react negatively. The net result is what? That depends. If there's an equal weight, then it doesn't go anywhere. So it depends upon the relative strength of what type of investors you are. Okay, so that is something very important, that we sometimes use the, hey, investors do this way. Investors' reaction is this. And in the process, we are tending to make a mistake that as if all investors are thinking alike. Their utility function, the investors' expectations are so different, and they are so heterogeneous. They are so different from one another. Yeah.
What we have to do for the growing stock? I mean, if we're looking for the stocks, for sure, there is undervalued and overvalued stocks. But sometimes there is a stock page where you see like stock it's higher price, but analytics says it's already overvalued. But at the same time, in a month, you're checking the stock page again, and it's growing. But the fundamentals are still bad. It there becomes better, but they're still like on the same level in proportion.
That's true. That's true.
For several years. So the stock has just grows in a curve of a rocket. But at the same time, like this, its ratios are still bad.
There is a that's a good point, that why this discrepancy stays for a long time. Sometimes we think this way, Ivan, that the gap between the price what should be and the price what is, the price what should be, as I said, is a fundamental price / theoretical, notional, and many other names I can give. And then there is the actual price, which is the market price. The gap between, the discrepancy between the theoretical price and the market price is so widespread that it takes a lot of time to get the correction. And by the way, even the theoretical price doesn't remain constant. Even that changes. So what happens? The market price is trying to be closer to the theoretical price. So we assume that the market price is changing, right? So here we assume that maybe the theoretical price is constant, but see what? Even your theoretical price can change. And what happens? This discrepancy remains forever. Rather, it becomes even more over time. So that is why this search of this lost spirits can take many years before they converge. And sometimes they don't converge, rather more often they never converge. Sorry? There have to be a correction, and the correction doesn't mean that they are always, when they become totally equal, only then they are correction. When they're tending towards, even if their gap narrows down a wee bit, even that is a step towards correction. So we see those steps towards correction as more important than correction as such. Okay, so we went too much into the technicalities of finance. So let's come back to valuation. And please feel free to ask me the questions or any query if you have. Where are slides? Here. Okay. So this is some background which we discussed already, that why do we study this topic? The first model that we shall study is called discounted dividend model, or DDM, of valuation. Discounted dividend model. It's a very important tool, a very important technique, but at the same time, it's very simple, very basic. It doesn't involve any nuclear physics. You don't have to be a nuclear scientist to know it. Very simple and straightforward. And it's based on the logic. Remember, in finance, when you look, if you try to memorize the formula first, you can be confused. Always see the reasoning, that why some terms are in the numerator, why are some in the denominators, why there are some plus signs and multiplication, and why in other cases it's minuses and division. If you know that reasoning, then learning a formula is not a problem. And I don't expect you to memorize the formula, because you're not going to. I'm not going to ask you, give me the formula of the present value of debt tax shield. That's cool. As long as you know the reasoning of it. Okay. So this whole theory of discounted dividend model is based on a very important adage saying, a bird in hand is worth two in the bushes. What do you mean by this? What do you mean by this phrase? Daniel is very quiet today. I mean, very unusual.
If you have something in hands and nothing, but you can notice it, but you can hide actually.
Yeah, that's the one way. Yeah, that's good. Fernanda, what do you think?
something that you have right now has more value than something that you will have in the future.
Great, great. That's very close to the finance explanation. If somebody offers you that, you know what, you have earned some money, would you like to take it today or after 1 year? What would you say? Why?
The value.
Money value change.
The money value usually, because we live normally in the inflationary society, and there's always some kind of other risks also. So there is always a danger that the value of the money over time will go down. So, and there is always a risk as well, because it could be possible that, for example, I'm offering you 100 euros now, and then I say, can you take it after 1 year, and you accept, and then I run away, I don't give you. So, but now I'm offering you, come on, take it, you know, game over. But so there is always a risk factor when you agree to wait. Okay, so that is something we discuss here, that the money which you receive today is relatively risk-free in comparison to the cash inflows which you get after certain periods. And longer is the period, more is the risk involved. Okay, I gave you example that between now and tomorrow, if I say that, would you like to have your money tomorrow or day after tomorrow? Tomorrow, because then the day after tomorrow would be riskier than tomorrow. So this is how we go for it. Okay, so the two elements in it, and you can, as you can see from the text, that a given amount of money received in the future is worth less than the same amount of money received today, as money has a time value. Over time, the value of the money erodes, and we don't want it to happen. And if you want to find, if you want to apply this model of discounted cash flows, you have to think about two things: the estimated value of the cash flows. The cash flow means cash outflow and cash inflow, and the rate of discount at which you are making this. Discount rate is a reflection of the riskiness. Remember, it's very important I share with you in the very onset that when I use the word discount, discount is a indicator of your riskiness. Let me give you an example. If I asked you that, could you guys give me money, and I would collect the money, pool it, and I would invest somewhere, and I'm representing the government. Situation A. Situation B. You don't know me, I'm a kind of private individual, and I make an advertisement that, could you guys give me money, and I would pool it, and I would reinvest it, and then I would give you money back. In which situation you think you are comparatively safer? To the government? Because the government is safer, yeah? It means what? When I say that after 1 year, I would give you 10% rate of interest. So you invest today, and you get 110 euros after 1 year. But is that 110 euros which you get after 1 year are worth 110 euros today? No. Why not? Because you use the rate of discount here, because the money is always losing the value. So you will be using some rate of discount. Rate of discount can include the expected inflation. When the inflation goes up, the value of the money goes down, yeah? When the rate of interest goes up, the value of money goes down. And also the risk, who you are, where you are investing in. In my case, because I'm representing the government, okay? In theory, in reality, the government don't become bankrupt, but in theory they can. So you also add some risk, even if there is a government asking for money. Hey, if there's a AAA country like Australia, if the Treasury of Australia comes to you and say, would you like to invest in the bond issued by Melbourne municipality? Look, Australia as a country is a AAA. But just imagine now, there is some local council of Philippines, and they ask you, would you like to invest in Manila Stock Exchange? Or, I mean, the bonds issued by Manila municipality? Would you be using the same rate of discount there? Do you see the same amount of risk? Now, I just said that the governments are safe, but now you compare two governments, one is still safer than the other. And if there's a private enterprise, then the rate of discount is again more applicable. So the rate of discount incorporates, when I say the word, hey, it's risky, it's unsafe, I'm unsure, these are qualitative expressions. But when I add all my qualitative expressions and I arrive at some numerical figure, let's say 5%, 7%, then all my thoughts are reflected through some quantitative number. So the rate of discount is a reflection of how much you are afraid of, how much you think there's a risk in this investment. It includes inflation, it includes interest. So all the risks which you can visualize, you include into that. Am I right? And again, one more thing, the rate of discount also depends upon how hungry you are for risk. If you are a very cautious kind of investor, I mean, you are always in the cave and I need to draw you out, I have to offer you more till you take a risk. You get my point? But if you are inherently a risk lover person, then even at a lower rate of discount, you can come and jump in the market. You can take it because by nature, you are risk lover. To the students of financial management yesterday, I gave an example that if I want to get debt or equity, and some people chose to have debt and the others chose to have equity. And one conclusion we draw yesterday that by nature, equity investors are risk lovers than the debt investors. The debt investors are by nature risk averse, whereas the equity investors are by nature risk lovers. But it doesn't mean that all the equity investors have the equal love for risk. If you invest in some utility company, the risk is low. But if you invest in some biotech, risk is huge. And so is in case of the government bonds. I just gave you example of Melbourne municipality and Manila municipality. Look, you started reacting to it, even though both are governments. Yeah. So always in finance, always take things with a pinch of salt. Sometime for a teacher like me, it's difficult to give a disclaimer in every sentence. But as long as you know that you will be seeing everything with a pinch of salt, and every word, every expression is a relative expression, not absolute. Remember, we are not studying divinity or any other kind of moral sciences. Here things can be interpreted differently by different people. Okay, anyways, so let's go to the next slide. Have an example. There is an asset, and the asset says that you would get a single cash flow. Let's say the Treasury of Finland asked you that, you know what, you make some X investment today. After 2 years, we would give you back 100 euros, okay, dollars, whatever, doesn't matter. And you are pondering over, hey, is this X price, which the Treasury of Finland is asking me to invest, Is it too much or too less? And then what you do, depending upon who you are, risk lover, risk averse, what type of risk economy of Finland is going to, you can see in next 2 years, you find out that 5% is the appropriate rate of discount. Yeah, 5% is the rate of discount. And then what you do, you divide $100 or euros by 1.05 to the power of 2. So it means why this is 1.05, because we always, the formula says 1 plus rate of discount. 1 plus rate of discount, and the rate of discount is 5%. So 5% means 0.05. So it becomes 105, right? And why do we have to the power of 2 square? Because this money will come not next year, 2 years later. So because it's after 2 years, so we put the power of 2. If it says you will get $100 after 3 years, then it would have been power of 3. And we find out that this comes to be $90.70. It means the fair price, the fundamental price, the theoretical price, the intrinsic price, the notional price of this investment should be 90.70. If the Treasury of Finland is asking you that, hey, invest 93 today in time 0 and get 100 after 2 years, no, they're asking for too much money. And if they say invest 89, 88 and get 100, go for it. It's cheap. The price should be 90.70 and they're asking for 88. Come on, go for it. So this way, this is one simple example using the discount rate through which you can find out what is the fair price of this investment. But remember, it's easier said than done. Reaching this rate of discount and estimating the future cash flow is a bit complicated. Look here, who is offering you 100? In this example, Treasury of Finland, right? So you, see what I'm saying?
Yeah.
They are offering you 100 euros after 1 year, right? 2 years. Who is saying it? Treasury of Finland. We trust the governments more. But if it was a private organization, some private entity, first of all, they would never say that they would pay you some assured money. You know, it's difficult to say. And even if they say, perhaps you will think, or maybe you will put the higher rate of discount. So for example, in this example, if it is not Treasury of Finland, it is some private organization, some IT company, then maybe my rate of discount will not be 5%, but rather 8%. You know why? Because I'm exposed to higher risk. Higher the risk, higher would be rate of discount. It also depends on who I am. If I'm a very risk conservative and very risk averse, then I would put higher rate of discount. But if I'm a risk, very flamboyant investor, then I would be even agreeing to invest at a lower rate of discount. So this rate of discount is very personal, I would say, very subjective thing. Yes, Daniel?
I just wanted to ask about the rate of discount, what is your answer, but it's like the personal thing.
Yeah.
Depending on what are you aiming for.
What you aim at, yeah. This is the formula. Okay, Fernanda, you have to memorize it in a few minutes. Can I give you 30 seconds to memorize it? Huh? Can you? Who can memorize it? Okay, it's sigma. Sigma means, when do we use sigma? Sigma is a Greek letter. Yeah. Sigma, we use this like E type sigma when we want to add something. So for example, if I say, yeah, 2, 3, 4. So I would say sigma x is 2 plus 3 plus 4. So this is sigma is used when we add something. CT. Can you see CT? This is the cash inflows over time period. So the cash flow in the first year, second year, third year, and then we put 1 plus R at the bottom. And what is R? The rate of discount to the power of T. How many years? Minus C0. C0 means cash outflow in year when? Now. In finance, when I say now, the expression is 0. So we are in time 0. Right now, we are in time 0. After 1 hour, we will be in time 1. After 1 year, we'll be in time 1. Depending upon, you want to see the hour-to-hour comparison or month-to-month. Yeah. So right now, when we are in the real time, we always show it with time 0. But don't memorize it. You don't need it. Okay. So rather, if I give you example, that would be much easier. And then you would be able to learn the formula in a more contextualized manner. Let's go to the next slide. Have a look. There is an investment opportunity. And the investment is that if you invest 100,000 euros, you are estimating that you would get a cash flow 25,000 at the end of year 1, 25,000 at the end of year 2, time 2, I should say time 2, or year 2 doesn't, year is a measure of time. So there is this investment is for 5 years. But your initial investment is 100,000 euros. And at the end of each time period, you get 25,000. So you invest 100,000, and you are getting 25,000, 25,000, 25,000 each year till 5th year. And then the investment is over. Now, I want to show you that how the knowledge of discount factor and without the knowledge of discount factor can make a difference. Imagine this person who is offered this option has no knowledge of finance, let alone the discount rates. And see what this person would say. He would say 25 plus 25 plus 25 plus 25 and plus 25, 5 times 25 plus 125,000. So the cash coming in is how much? 125,000. And how much is cash going out? Cash outflow? One-time investment in time C0. 100,000. Difference between sum of, see this, look at this formula, look at this part. Can you only focus on the CT and sigma? It shows sum of all cash inflows minus one-time investment. And this guy, this person in this question, in this example, we assume that he has no idea what is rate of discount. And then what he does, sigma CT minus C0. Oh my gosh, he's so happy. 25,000 plus. Hey, this is a great investment. Until somebody among you who has better knowledge of finance comes, hey, wait a sec. Have you heard about this phrase, a bird in hand is worth 2 in the bushes? And then you start explaining about the rate of discount and all those intricacies. And then you say that, you know what, I think the rate of discount which you should use is 10%. Yeah. So let's say in this example, we use 10% rate of discount. And you find out, yes, Daniel.
Sorry, maybe I'm wrong, but this one percentage, this one 9,009, it's not correct, because like I just calculated and it's like 0.990.
Yeah, well, that's not a problem. Calculation is not a problem, but the main idea is the problem. I'll explain it to you. Wait a sec. I have some Excels as well. So basic idea of this 0.909, let's assume that it's correct. The basic idea of this 0.909, if somebody asks you that, hey, you know what, can you explain me the rate of discount in a layman's language? Hey, I have no idea of finance. I took Shab's lesson, but they were too complicated. I couldn't understand it. Can you explain it? So basically you are saying that, hey, you take €1 now, But if you choose to take €1 after 1 year, that €1 which you take after 1 year is worth 91 cents. So you have lost 9 cents of value. And if you choose, if SHAB is offering you €1 now or €1 after 2 years, you know what? The euro which you get after 2 years is worth 82 cents of today. So you're losing money. With me? And then what you do until you reach at the 5th year, where the present value of the euro which you receive after 5th year is 0.621, 62 cents. So the euro which is today, euro, would be worth 62 cents after 5 years. Okay, and then what you do, you multiply column 2 and 3. So basically, the money which you receive, even though the external value of the money is 25,000, but the real value of the money which you get after 1 year is 22,725. So much so that even though the face value of money you receive after 5th year is 25,000, but the real value is actually 15,525. And guess what? Now you add sigma. Now you add those cash flows like this. We did the first term here. So sigma, add all the discounted cash inflows, and it comes to be 94,750. Obviously, it's less than your initial investment. This investment would have been disaster had you not known the concept of discount factor. And how these, you get the idea? Could my online friends let me know that do you understand this idea of discount factor in this example? Because that is the basic foundation of entire topic called valuation. Discount factor. So many investments which on the face value look very promising, they are not so promising. But because in this example, if you only add 25,000 5 times, which makes 125,000 minus your initial investment, it looks very nice. You're earning 25,000 in 5 years. That's great. But when we include the notion of discount factors, this investment looks very clumsy. No. And how do we do it? I can quickly show you with the spreadsheet also. I think I have the spreadsheet here somewhere. Let me see. I actually uploaded, I have uploaded, wait a sec. I did upload the spreadsheet here as well. If you go to the course contents and study material, there is a folder called spreadsheets. And the first spreadsheet which I uploaded today is this discount factors. But let me show you something. Please bear with me. I'm trying to open my folder. Discount factors. Discounted cash flow, yeah. And now I can share my screen with you. Yeah. Where is the spreadsheet?
Let me ask you something.
Mm,
Why did you take factors?
sorry, just a second. Let me open my file first. Then I would be in a better position to. Just a sec. Oh, it's here actually. Or actually, I can share the whole screen so that it doesn't disappear. So, folks, do you see the spreadsheet now? Do you or not? Can you see in Excel?
Yes, we can see.
You see it? Good.
Yes.
Yes. What's your point? Ivan?
Why don't we take the presentation 10% as a constant?
Because it depends upon, as I said, that the discount factor depends upon many variables. The first variable is that who is asking you to invest? Is it the state, the government, or the private entity? Are you risk lover? Are you risk hater? So when we and what is the risk of inflation, interest rates, macroeconomic risk? So when we make a list of all the foreseeable risk, yeah. Because look, in 2 years, your GDP rate can go down, the unemployment can go up, inflation can go up, the interest rates can rise. The countries, if this offer is given by some foreign company, let's say you are in Finland and this investment is offered by New Zealand, it could be possible that the New Zealand dollar value goes down against euro. So even though the face value of the interest you earn is very high, but when you convert New Zealand dollars back to euro, you get nothing. No, it includes a series, it's a big checklist. And even no checklist is complete because it depends upon what you want to see. As I said, some people are prepared to take risk much easier. They either ignore some risk or they don't give much value to those risks. But some people, especially when you're an extreme risk averse investor, then you really go deep and you make even deeper analysis. Okay.
Like we're talking about the worst scenario. If we're taking
Yeah. We always take if you are an investor, we always look at the downside. Look, risk can also be an upside risk. If I asked you, you know what, Yanni, I have an offer for you. You invest 100,000 euros in my company, and I assure you that you will be getting 10% rate of return. But you know what? There is a risk. The risk is that this rate of interest, this rate of return, 10% can also be 20%. Is it even a risk? Look at the expression. I repeat, I think now you will be in a better position to say it. I say, Yanni, invest 100,000 euros in my company. The minimum rate of return, which I promise you, is 10%. But you know what? There's a one risk. You have to be very careful. And you may choose not to invest. The risk is that this rate of return can also be 25%. And you will say, Shab, are you crazy? Is it even a risk? Risk is about uncertainty. Uncertainty leads to risk. But the question is that what? So any deviation from the normal is an uncertainty, and that involves risk. But the point is that, is this risk beneficial to us, or is it harmful? Is it upside in this case, or downside? So you will be more worried if I say, Yanni, invest in my company 100,000 euros. I give you a guarantee of 10% rate of return, but you know what? Maybe in third year, it's possible that the rate of return goes down to 5%. So when you see the downside, that is a risk. We never go gaga about the positive side of the potential investment. We always look conservatively. We always look at the downside. We never prematurely account for our successes, but we always prematurely take account of our possible losses. Yeah, whenever you, and it's not only in the field of finance, it's in every walk of life. When your train is leaving the platform at 9:15, and you still have 45 minutes, and the station is only 10-15 minutes away from your place, there is still some element of which push your heart palpitate more than usual, isn't it? We say that, okay, if we are driving, the train station is only 10 minutes, but you know what? It could happen that there is a traffic. So you always incorporate or visualize all the bad things, or there may be some accident in the road and the road is blocked. It could be possible that your car breaks down. You never visualize that you will be going to the car park, and instead of car, there would be helicopter, which takes you in 30 seconds. So you never go for the upside thing. So we always think cautiously. Okay, coming back to this example, and then I give you a short break. This is the same example, but I put the formulations, and you can see that time 0 is the time now. Now, if you invest, it costs you $100,000. And can somebody tell me why I put minus sign in front? Why did I put minus sign in front? Because when you invest, investment is a spending. And spending means the money is leaving you. It means it's a cash outflow. And when the money comes in after 1 year, 2 years, 3 years, 4 years, so on, so forth, these values are positive because this would be cash inflow. Yeah, so it's a logical thing. If you were not at all aware of the concept of discount rate, then you will be adding all the cash inflows. Can you see the formulation? Sum in symbolic terms represented by this sigma, which I wrote in the slide. Okay, and that makes, and here you can see that your cash inflows plus cash outflows. Yeah, make sense? And guess what? It's positive. You're very happy. But this is, what is the phrase when you are living in fool's paradise? It's like, it's not a reality. And then somebody tells you that, you know what, there is a discount factor. And here you can see that 10% rate of discount. And here you can see that the discount factor is this. So the money after 1 year is 90. And you can see the formulation. Yeah. So 1 divided by 1 plus the rate of discount, because the rate of discount is 10%. So I put the dollar sign in between so that it remains fixed to the power of the time period. And as you can see here, by the end of 5th year, it comes to be 6 to 1. And then we find the product of 2 values. Yeah. So the cash inflow multiplied by the rate of discount, not the rate of discount, but the discount factor. And as we go on and on and on, we find the sum of this, which again is a sigma. Yeah, Laurie, sigma, sum. And then we find that, hey, this is negative. We are overall investing 100,000. And in reality, even though the face value, if you count the notes, you still get 125,000. But the present value of that money is about 95,000. So you are technically losing 5,000 on this deal. You shouldn't go for this type of investment. Yep. So
Eventually, after all, if we take 10% risk discount rate, eventually we have a lose. So I mean, in the worst scenario, we will be losing money.
Well, what can be more worse than this? This is, you're losing money already. So whenever you are an investor, you get many offers of investment. Okay. Your first filter, your first point of filtration, I shouldn't say flirtation. Your first point of filtration is that, is this investment negative NPV? And if that is negative NPV, then we don't even consider at all. It's thrown away in the first instance. you only look the positive NPV project and then pick up, of course, even if you have list, okay, you have 100 offers of investment, 60 are negative NPV, they are shortlisted in the very beginning. You're left with 40, okay? 4040. Now, unless you're a billionaire, you can't take all those 40 projects because you have a limited amount of investment. Then you only pick up those projects out of positive 40 NPV left over, which gives the highest possible NPV. Let's say you can only afford 5 projects. Then among all the 40 projects which have the positive NPV, you pick up top 5 in terms of highest NPV and then go for it. Okay, but I want to play with the numbers. For example, if I make it to 5%, just in case, let's say, if I'm a bit more flamboyant. Yeah.
Maybe you use apply it to the stocks, for example. Investment.
Say again.
Might it be applied for stocks or any investment, right?
No, it does apply for the stocks also. I mean, if for example, if you make a investment in a company in the stocks and you can forecast the dividends in the future, by the way, the sum of dividends, in theory, the sum of all the dividends in the future which you receive from the company should be equal to the price you pay today. So dividend is a cash inflow and the price you pay to buy a stock is a cash outflow. So this logic applies to all types of investment. Okay, so let's take a short break now. Let's say about 10 minutes. And then we have some discussion. I know this topic will not be covered in one meeting, but rather it's a good thing that we are not able to cover it in one meeting, because then we are able to discuss more those things which otherwise I wouldn't have discussed with you. So short break for 10 minutes from now. And folks, we meet in 10 minutes, okay? So come back, then we discuss. Okay, so start recording. So if, for example, you change your discount factor from 10% to 5%, let's say there is less possible risk of inflation, interest, exchange rate, or GDP loss, or unemployment, plus you by nature are more risk lover than before, and you are convinced at 5%. So you are willing, not 10%, but at 5%, you're ready to invest. Then guess what happened? Then the euro which you receive after 1 year, it used to be 0.90 in the 10% example, right? But now the euro which you receive after 1 year is 95 cents. After 5th year, when it was 10%, you would be getting 1 euro would be equal to about 62 cents, but now it's 75, 78. And guess what happens now? In this case, this is a positive NPV project now. And similarly, if you change any value, this should work. Yeah, make sense? So I take it back to 10% because that's the whole idea. Huh? This you have to bear in your own mind. Sometime this is usually what happens. Try to understand. Not every investor is financially sophisticated. So in this case, when you meet your financial consultant, then they have a word with you and they interact you and they do all kind of communication. This is why the communication are very important, even in the field of finance, the soft skills, so that you are able, the guy who is investing on your behalf knows you in and out, like a lawyer, like a doctor, like your GP knows everything about you. So same way, the financial consultant knows about you that, okay, this is what this person wants. But if you yourself want to go for it by yourself, because if you have a background and education, then you can ask yourself, okay, 2% is the rate of inflation I see. There's a possibility that the interest rate will jump by 1 more percent, so 2 plus 1, 3. There's a 2% possibility that the euro would appreciate against New Zealand dollar, 2% more. And then you can also see some risk premium that we did in financial management course. So when you make this estimate, you can have some rule of thumb, a rate of discount. Yeah. And if you are doing it through your financial, some broker, many times when you, this financial consultancy and the brokerage services are given by the same company. So when you are a client. Yeah, I keep this. And now we go to the slides once again. And we discuss. The question is, now I'm giving you more precise answer, Laurie, that where does this R discount rate comes from? Yeah, the discount rate comes from some tried and trusted, well-established financial models. And one of the financial model that we have, which is, you know, we do it all over the world. I mean, this is such a beautiful model. It was developed by Harry Markovich, and then some other Jensen and many people, they develop it. And if I'm not wrong, this model, capital asset pricing model, has won at least 2 Nobel Prizes in economics, because such a popular model is this. And I would like to share with you that not long ago, we used to have a student in our, this R come from this very important model called capital asset pricing model. And if you look at the capital asset pricing model equation, the expected, or rather I should say the minimum expected return on equity investment is equal to RF, or subscript F. RF is risk-free rate of return. And the risk-free rate of return is basically the 10-year treasury bond rate. And this data we took from Bank of Finland, Suomi Pankki's website. So 10-year bond rate plus the expected return on the market portfolio. And the market portfolio we took, it could be in America, it could be S&P 500. In UK, it can be London LSE, FTSE 100 index. Because in Finland, where we use this NASDAQ, so we took this NASDAQ index minus the same term, risk-free rate, multiply by beta. Have you heard about beta? Yeah, beta is a term which measures the market risk. How do we calculate it? You have to hold your, if you have done financial management course before, it's fine, but those who haven't done it, they would do it soon in financial management course. Okay, so we calculate beta. And beta is a measure of sensitivity. Okay, so if I can quickly explain to you what beta is, then beta is this, basically. If I have a new line here. If I say that this is Finnair stock return, and this is NASDAQ return. NASDAQ, why NASDAQ? Because I took the index or the market return.
Because Finnair is also traded on NASDAQ.
Yeah. And if this is the line, which shows the relationship between when the NASDAQ index moves and the Finnair stock moves. And then the beta would be equal to change in Y. And who is on the Y-axis? Finnair stock return. Divide by change. Change is normally represented as a symbol by delta X. And what is X? The index or the market return. And let's say that this, when you calculate it, I'll explain it to you in the financial management course. And if the need be, next week I can actually do with the spreadsheet here as well, no problem. And let's say this comes to be 1.25. 1.25. Basically, this 1.25 means if the entire Finnish market goes up by 1%, the Finnair stock goes up by 1.25%. And if the NASDAQ goes down by 1%, then Finnair stock goes down by 1.25%. So the Finnair stock is more sensitive than the average market. When I say more sensitive, it means more risky. It means that it comes in the category of risky stocks. Don't take it for true. I'm just making the example. It's not true, but I'm just giving with these numbers, 1.25. But imagine this beta comes to be 0.70. In that case, you can say that if the market goes up by 1%, the Finnair stock goes up by 0.70% and vice versa. So in that case, the same, we can say that this is comparatively a safer stock, less risky stock. The rule of thumb is that if your beta is more than 1, this stock is good for risk lovers. And if your beta is below 0.8, this is good for risk-averse investors. But if your beta is between 0.8 and 1, yeah, it's good for the risk-neutral investors. Some investors are risk-neutral. They can take the calculated risk, but not too much. Okay, so the beta is a first indication of your riskiness, how much risk you are prepared to take. Okay, now let's put this back to the numbers and go to the slides again. Now imagine your RF risk-free rate in Finland is 0.5%. Let's say, just imagine, I'm just saying that risk-free rate RF term is 0.5%, right? And beta of the company which we think about is, let's say, is 1.25. And if you invest in the index, the average market return is, let's say, is 7%. And then we minus risk-free rate, which is 0.5%. If you make this calculation, it comes to be 6.5 multiplied by 1.25. How much is this? 6.5 multiplied by 1.25. Is it 8 point something? 8.125 plus 0.5. So it comes to be 8.625. Yeah. 8.625. Yeah. It means that the minimum return which an investor must expect, not should expect, must expect on this project, this investment is 8.625%. This we use as a rate of discount. If a company is fully equity financed, if a company is fully all equity financed, no debt, then the rate of discount would be 8.625 as we have in this example. But we know that the companies are also having some debt as well. Yeah. Risk-free rate is the rate at which the state of the country, the central bank of the country borrows, the treasury. You see, in every country, there is a Ministry of Finance. The Ministry of Finance issues some securities. They issue for maybe for a few days and even up to a few years, right? If they are borrowing from you by issuing some securities for less than 365 days, then it's a short-term investment. In finance, the definition, the line of distinction between short period and long period is 365 days. Any investment below 365 days is a short period, and any investment for 365 days and above is a long period. Okay, for the short period investment we call as a bill, but for the long period we call it bond. Treasury bill mature within 365 days, but treasury bond mature, it can mature for many years. And as a convention, the risk-free rate is taken as a 10-year treasury bond rate. So basically, if the state of the country asks you, the Ministry of Finance asks you, could you lend me 100 euros for 10 years? So that rate of interest which they offer you is called risk-free rate. And why we use the state and the ministry's bill rate? Because state is risk-free, right? Risk-free. Who's risk-free? State or a private company? State. That's why we take the state rates, the ministry rates, Ministry of Finance. Make sense or not? So risk-free rate is, a country is riskless comparatively, even though in theories the countries have failed also. But in practice they don't fail because then there's a bailouts and all that stuff coming in the picture. So this way we can calculate the rate of equity, the minimum return which you must expect on the equity. But this this RE would be used as a discount rate if the company is all equity financed. But we know that the companies are also debt financed. The companies also have a debt. And let's see what I have done in the formula below. I calculate the weighted average cost of capital. The weighted capital includes debt and equity, okay? Am I right? For equity, I've done the calculation already. For debt we multiply the weight of equity. Weight means if the company is 60% financed by equity, then we multiply 60% with RE, which is 8.625%, okay? And if it is 40% financed by debt, then we multiply 40% with the average cost of debt, which is very easy to see in the company books. All you need to see is in the income statement, look at the amount of interest expense and divide by the total debt. That would give you average rate of what? Average rate of interest or cost of debt. So if you see that in the income statement of the company has paid $1,000 as interest. Yeah. and then you look at the company's balance sheet. On the liability side, you find that the company's total finance debt, the borrowing, is 100,000. Well, let's say 200,000. Divide by 200,000. 1, 2, 3, 4, 5. Yeah, is it? Am I right? 200,000. And this comes to be 3. Maybe this is one more zero. Yeah. So let's say this comes to be 5%. Yeah. So you get the rate of debt, or the interest on debt is 5%. But you know what? There's one more term here, 1 minus TC. What is 1 minus TC? Yeah.
It's kind of a subsidy from the government to the companies who have a debt. Because
the companies, they have some kind of subsidy. Do you know that how many of you have seriously looked at the income statement? If you take it as a homework, go home and check income statement of any company in the world. You will find that the interest expenses are calculated in the income statement before the company pays tax. Are you with me? Interest expenses are accounted before the company pays tax. It means that amount of cash stream which company gives to its debt holder is tax exempted. On the other hand, the dividend which company gives to its shareholder is measured after the company has paid tax. So that way, the shareholders are treated somewhat unfavorably, according to one argument by the taxman. Make sense? It means that the company is not fully paying 5% cost according to this formula. We need to remember that this 5% is paid before company paid tax. So what we do? We add one more term here, which is 1 minus TC, which means 1 minus income tax paid by the company. So just imagine, if cost of debt is 5%, how much? 5%. And the income tax, the corporate tax which company pays is 25%. Then actually the company is not paying 5%. Company is paying 75% of 5%. Because company is getting some subsidy in the form of not paying tax. Because debt holder are not tax imposed. So therefore, we add this term 1 minus TC in between. You have to be careful that why we add it, because debt holders are treated nicely. Actually, I can give you an example, because otherwise you will be a little bit unsure what I'm talking about. Let me give you an example of BP annual report, whatever, whichever year, doesn't matter. Who cares? Who cares? Did I get the? Yeah, I get the balance. I get the income statement. Let me share the screen with you very quickly. And let me take you through the income statement. Yeah, here we go. And now, because in the project you'll be working on FinAir and KLM, so it's worth having a look at this. Have a look at this. This is the tax which company is paying. I hope you can see it. Am I sharing screen with you? Okay. This is the tax which company pays, right? Can you see? And this is the finance cost. This is basically the interest rate which company is paying. Finance cost is including the interest rate which you pay, plus, yeah, basically it's interest cost. Is it before you pay tax or not? And look at the BP shareholders, what they get. Is it after the tax or before the tax? So who bears the burden of corporate tax? Debt holders or shareholders? Shareholders. It means debt holders are exempted from tax. So it's a big argument that the tax authorities treat the debt holders nicely than the shareholders. Laurie, are you fine with this argument, or something is popping up in your mind?
No, I think it's pretty clear.
Yeah.
But it's unfair.
No, I'll tell you why.
Why?
Remember, if these people are debt holders and you guys are equity holders, okay? They people are not paid tax, they're not burdened by their corporate tax, and then they take all the money from the company without paying any tax because they are given interest before tax. But at the end of the year, they will also file their income tax return, personal income tax return. So they would pay at least one tax, which is a personal income tax. You guys would be paying two taxes. One, the tax which the company is paying on your behalf. And secondly, you also file the tax return at the end of the year. But it doesn't say that the final burden of tax of both taxes on you is more than theirs. No, the bell ring. You pay tax twice.
Yeah.
They pay tax once.
Yeah.
But it doesn't mean that you pay more tax than them. The sum of, even if you pay tax twice, let's say 2%, company pays on your behalf, 3% overall, your return, you pay 5%, right? They pay no tax in the first time, but in the second time, they end up paying 7%. So just because you pay tax twice doesn't mean that you at the end of the day pay more tax than them. Because many times when you are paying your personal income tax, the income on entrepreneurship is given preferable treatment. When you invest in the stocks, it's an entrepreneurial income.
When you sell stocks, you have the same tax.
Yeah.
30%.
No. The taxman treats these different categories of income differently. They do, yeah. Comparatively, relatively safer streams of income are treated harshly by the taxman in the final tax return. And where there is more entrepreneurial kind of income, then there's more exemptions given. So it could be possible that you pay 2% and 3%, overall 5%, and they pay 0% and 8%. So it's possible. So just because the corporate tax is a little bit harsh on you, at least in the beginning, in the first instance, doesn't mean that who knows, at the end of the day, you pay equal finally. So that is the idea. Okay. Now coming back very quickly before I let you go, is that that once we make this calculation, yeah, that is called weighted average cost of capital. Now imagine that you have 60% of equity, you multiply 60% with this item, then 40%, yeah, with the cost of debt. But don't forget to insert in between 1 minus TC, because remember that the tax man, even if you pay 5%, basically you're paying 3.75% because you don't pay for the tax, income tax. So whatever the value it comes here, that is called as weighted average cost of capital. Yeah. Capital includes what? Capital includes equity and debt both. And this WACC can be used as a rate of discount. For each company, it would be different because each company has a different beta. If you look at this, risk-free rate is common for all the investors in the country. The Swami Panki, the Bank of Finland, issues 10-year bond rate for everybody. Everybody who looks at the website sees the same value. Return on the index is same for everybody. Yeah, isn't it?
Yeah.
If I say, take the NASDAQ data for last 10 years, you take last 10 years, you take 10 years, the calculation would be same. There is a difference. Difference is the beta. Riskiness, market risk. This beta makes a difference from company to company. And then what happens? When you calculate this RE and then you adjust with the RD, the cost of debt, that gives you the weighted average cost of capital. And that you use as a rate of discount. And guess what, Laurie? One more thing. This part of rate of discount doesn't change from person to person. This change from company to company only. Look, this is even better, more objective, more standardized. If I ask you guys, can you find out the rate of discount on equity? You guys will come up with different figures. But here, according to this formulation, you all will come with this one common figure. Only if you take Finnair, it'll be different. If you take Nokia, it'll be different. If you take Nordea, it'll be different, and so on. But for every person, so the personal manipulation, that subjectiveness will be minimized in this case. So this is even more objective measure, better generalized, standardized measure, return, the rate of discount. Okay, I stop here because today we had quite deep, intense discussion. Yes.
So basically, these two measures, like whether there is cost of capital and capital, they influence this one rate of discount, which we estimate before our investment.
Yeah, yeah.
So it's basically the influence in that because we need first to estimate this one too.
First,
there are kind of a key one factors which we are paying attention to before the investment.
Yeah,
yeah, exactly.
Yeah. But guess what? You guys can now challenge me. Shab, you said that there can be inflation. There can be interest rate fluctuation. There can be exchange rate fluctuation. Where is that? Come on, you are ignoring those hard, harsh realities. Then my answer would be beta incorporates all these risks. So beta is like a, we have a saying in India, and if I translate in English, it's not a good translation, but we say that in India that elephant's foot includes everybody's foot. Because it's so big. So all the feet can be covered in one foot. So beta incorporates all the possible risks. So you don't have to worry how much is inflation, how much is interest rate, don't care about it. Beta measures all the risks. Trust beta. Rather than making your own, fluke or guesswork, trust beta, which is based on calculation. When we shall do this calculation soon in financial management course, in the next few days, we'll do it. Sorry?
How we calculate is
You mean the cost of debt? Very simple. Go to income statement. I show you. Let's do it right now. No, let's do it now. Expected debt returns. We'll do it now. Give me 2 minutes. Let's go back to this spreadsheet. How much is the interest expense here, Fernanda? I think it's 3489. Yeah, 3489. So it means your cost of debt numerator is, remember, write it down, 3489. I can also write down 3489 because I can do at the end the calculation. 3489. and then divide by the total debt you have. Question is, where is total debt? The total debt is here. Total debt is in the balance sheet. Go to the balance sheet and look at the first we have assets, then we have the liabilities. Look at the finance debt for the short period. How much is this? No.
Oh, yeah. 1048.
10487, right? Plus, how much is the finance debt for the long period? So approximately it's 67,000, right? Approximately it's 67,000. So if I divide 3489 by, let's say, approximately 67,000, it comes to be 0.52, so it's 5.2%. So the average cost of debt to Finnair, was it Finnair? No, BP. So the average cost of debt to BP is 5.2% a year. So that's, and then you adjust for the, remember, 1 minus TC, yeah, that you have to bear. You have to remember it that the tax man doesn't burden debt holders.
It's not ratio, so it's in euro.
No, the average cost of debt is in the percentage. Now, look, this is 5.2%. Yeah. So if I show it in the form of, wait a sec, if I change the format and I make it a percentage with 2 decimal points, it's a 5.21%. So it's a percentage. Yeah.
So the formula could be like finance debt.
No. The finance cost.
Finance cost is the total debt that is short debt and short term debt
Plus long-term debt. Yeah. And remember to use the brackets. Yeah. So total cost of debt. In some annual reports, they use finance cost. Sometimes they call interest cost, interest expense. So different phrases they use. So as long as you know what to do. Yeah. And then the total debt you take from the balance sheet's liability side. Look, both short-term liability, which you call as a current liabilities, and the long-term liabilities, which you call as the non-current liabilities. So when you add them up, that's your total debt. Yep. Okay, great. Thank you very much. I know this topic is a little bit, it's not just we are learning the topic, but we are also learning some related topics as well. So it's very obvious that we go a little bit off track, but that off track is more important than the topic per se, remember. So next week, we will continue on the valuation topic. And once I get the recording, I would be sharing it with you. Okay. Why email?
Or like through email.
Why